Hello and welcome to Onchain Reaction. I'm your host Tom Salter, and today we'll be looking at the on and off chain to figure out why we've had a recent price spike in Bitcoin. So without further ado, let's jump in. Firstly, we've got a technical chart here. I'll just quickly run through this. We're looking at trying to analyze the trend here. Are we in the range? Did the spike equal a breakout in Bitcoin price, which would be positive for investors? And as we can see, we're still very much within the 280-day moving average. We've done the 280-day as opposed to 200, simply because with Bitcoin, it's a 24-hour market, 7 days a week. And therefore, you should count in the 2 extra days every week due to the weekend. As we can see, we're still in the trading range, as I just said, and therefore, we're not breaking out here. And actually, that might come to some people as a surprise, since this about 5% price rise has gained a lot of attention. But as we can see, we're still there and we're still teetering on the edge. And without further ado, let's look at why the on-chain might give us an answer to whether we can go through that price range, which obviously we all want. So firstly, we're looking at fees here. And just overall on-chain, the medium-term slump I've been talking about in the past couple of weeks continues. Most significantly, as we can see from the chart, is fees. Fees are essential to a network, and they should be an investor's first port of call when deciding how healthy a network is. The collapse of fees, as we can see on the chart, shows very, very bad network, or unhealthy, not much usage going on. And if we're considering Metcalfe's law, we're looking at the value of a network, this is not a good signal. Fees are unhealthy, and they show no potential for recovery as of yet. We really need to see this turn up just slightly, just a tick up or into an uptrend, and we could be looking at a healthy network if something like transaction value comes along. Moving on, secondly, here we're looking at the transaction count, and this, I should mention, is an absolute metric, meaning there's no interpretation to this number. This is exactly how many transactions on the network. And sort of the opposite of sort of this bleak outlook on on-chain we've had for a couple of weeks now, this actually is a positive outlook. As we can see, transaction count slowly climbing up. This is very positive because transaction count could be one of the major metrics allowing us to go up across the board. By that, I mean a domino effect. So higher transaction count equals typically higher amount of value transacted overall, and that in turn will increase network fees. Those three create quite a valuable trifecta. At the moment, we're just seeing one of the three slightly perk up, but in effect, hopefully with higher transaction counts, the other two should naturally come along. And I mentioned earlier that it's an absolute metric, and as I'll explain in one of my penultimate points, this is very key nowadays as a trend coming up is the analysis of actual data sources, and whether or not when subjectivity comes into it, whether or not a data company is looking at it in the right way. With that being said, let's move on to off-chain. As we can see, just a recap, the on-chain is weak, and I won't spend much time on it because previous weeks have said very similar things. One main point is that transaction counts are coming up, and that's very positive, and we would like to see that continue. And if I was an investor, I would be looking at that trifecta I mentioned very closely: fees, transaction value, and transaction count. Institutions have been very, very pivotal in this rally, or in the last 6 months. And as anyone involved in the space, it's as a activity, we value the institutional activity the highest. Here we're looking at Bitcoin fund flows, but first let me mention about Bitcoin held by funds. Both of these charts you can find on the ByteTree website. Stagnant is probably the word that perfectly describes Bitcoin held by funds. We've seen no net change in Bitcoin held over the last couple of months. And while we appreciate that the institutions are holding this Bitcoin, this is not a positive position to be in. In fact, I feel like this is very shaky, and the market should be quite worried about this, because should this number decrease, we could see some pretty volatile market movements. Now, looking at the chart, much more distressing picture from inflows or outflows. Here we're looking at fund flows, in fact, and as you can see, since January, there's been quite a large drop. Over September, constant outflows, and I feel that the market isn't quite pricing in this activity, considering how much everyone talks about institutional activity being valuable. I believe the market isn't reflecting that in the price. If we look at the actual number, we're seeing consistently 900 Bitcoins over a 90-day cumulative lens coming out. 900 Bitcoin, sure, very small, and it has recovered over quite a large trough, meaning there's been quite a lot of Bitcoin outflow, and still is outflow, and we're coming to the precipice of possibly seeing inflow. But as we can see, it's still outflow, and that's really not good considering the price is going up, and that's why I don't think price is reflected. So let's look at outside Bitcoin. Bitcoin is not just the on-chain, it's not just the institutional, but there's parts of the digital asset ecosystem which play a massive part in how Bitcoin performs. And of course, I'm referencing stablecoins here. Stablecoins, as far as their growth, has been astronomical over the past year. Firstly, considering DeFi summer, this is really where stablecoins came to the forefront. And now we're just seeing every trading pair of the major assets, the largest trading pairs are typically always stablecoins. So in the next couple of slides, I'll be looking at two main outside factors which an investor might consider looking at when asking themselves, why is Bitcoin doing what it's doing? It's a question many of us ask ourselves all of the time. And with so many data sources out there, how can we know what we're looking at is correct? So that brings me on to the first slide. The title being, is the market making decisions based on dodgy data? And although a bit of a loaded question, it's a really key issue. So a theme this week, if you've been active on Twitter, you would have seen many companies, data sources being questioned for their data. And really, they're not questioning absolute data, which is what I mentioned earlier, which is transaction count. They're questioning things like transaction value, which for someone less well-versed in UTXO analysis, so unspent transactions, which looks at block by block what's going on, the value transacted, to whom and how many. This data is not as straightforward as one would think. In fact, something as simple as transaction value can be very, very complex to calculate. This comes back to privacy preserving transactions, bit of a mouthful. These are actions which try and, obviously in the name, try to preserve the privacy of a person. This can be done through tumbling. You can also have many different ways of trying to preserve your privacy. And these sway the transaction value, the true transaction value. In a way, how Bitcoin works is you send your money and you get change back, which is the remainder between how much you're sending and how much you needed to send, in a way. So a good analogy, which is coming out in our network demand model, is if you wanted to send 50p's worth of value, you would say, and you had £1, you would send your £1 and you would get 50p back. And obviously the 50 remaining would go to the person you wanted to send it to. So that would all be recorded on the blockchain. What some data sources are doing, they're recording all the value transacted, which would be £1.50, 50 cent, £1 had, etc. It's quite hard to explain on here, but essentially they're recording everything and they're ignoring what we would consider economically valuable transactions. We will record that small transaction as 50p's worth of value transacted, which is simply the 50p one person sent to another. We don't want to calculate the change because we don't consider that economically valuable. So on this graph we've got here, we're looking at something we used to call, well, we call now legacy transaction value. And this is what we believe some data sources, I won't name names, some data sources are using. And really the deciding factor between where we've come now and where we were with legacy is filtering those transactions, exactly like the analogy I just said. So why is this useful without getting too geeky? Essentially, this could present quite a systemic issue within the space. When you count every bit of transaction, every unspent transaction, all the change in the network, you massively multiply the true transaction value, the economically useful transaction value, to a number which is just bears no resemblance to the transaction value actually going on. And if you think that 50p economically useful and £1.50 overall for all the money exchanged hands, that's 3 times more. And sometimes that can be even larger. So we really need to ask ourselves what data source we're using. We need to look into how they do their analysis, how subjective, what their method of subjectivity actually is, and decide who we use, because otherwise, you could be making what you thought were informed decision on data which just isn't correct. And we'll be releasing a lot more on this over the week, so do check out ByteTree for that. So finally, possibly a more exciting part of the ecosystem, this is stablecoins. And as we've seen, stablecoins over the years have grown into really something quite influential in the space. Starting with DeFi summer last year, stablecoins really came to the forefront and actually governed how DeFi grew, and it grew alongside it. If you look at stablecoins in trading terms, they typically are the largest trading pairs for each of the major cryptocurrencies. For example, Binance's BTC tethered pair has traded over $1.5 billion in the last 24 hours. These are massive numbers. And actually, when you go down the list, typically they're to USDC, to USD, all of those stablecoin alternatives, rather than something like ETH or any of the other cryptos. So an investor should be encompassing the growth, what's going on with stablecoins, etc., really analyzing stablecoins when trying to make an informed decision about investing in Bitcoin. Because, as we've seen, they really have an effect and they flow a lot of money into the Bitcoin space, not necessarily something you'll be able to measure on the Bitcoin network. So in the chart below, we've got stablecoin velocity, and this is the number of times stablecoins exchange hands over a given period. In this case, it's 30 days, but on ByteTree's website, we tend to use a larger subset. So if we look at Metcalfe's law, which we really look at when we're valuing Bitcoin, since it's a network, in effect, connections are created every day, and doesn't particularly matter the amount of value transacted over those connections, it's getting the connections themselves. With velocity, you are directly analyzing the connections made over a network. If there's more velocity, i.e. coins change hands more and more connections you would assume are being created there. So with the rising price in Bitcoin or the recent spike, you would expect people to be trading, net market activity to be much larger. When in actual fact, if you look at the range I've identified, we're at a very low range. And the most distressing part of this is the USDC and the USDT lines. These are the largest stable coins by a foreseeable margin, both sitting around $30 billion. So their velocity has dropped dramatically, which signals a slowing wider network. And although we consider Bitcoin the market, a market surrounding Bitcoin slowing is not good news. So overall, stablecoin velocity is in bottom band, and that is really notable. Bitcoin needs the stablecoins, they come hand in hand for sure, but both need to be growing. And at the moment, they're stagnating or even falling. The Onchain shows a bleak picture, with the exception of short-term transaction count. But for a professional trader, you want the long-term, and really the long-term picture for what Onchain has been bleak. The off-chain cements the point of a stagnant network. BTC funds are struggling to get their cash out of their pockets and put more in. In fact, they're cashing out. And this isn't good. Constant outflows need to stop. And institutions really need to become comfortable in the network. And I believe that will have a knock-on effect to the wider markets. A distressing picture from data discrepancies. And I would imagine as a trend, this continues to grow, people actually drilling down into the subjectivity of how data companies are analyzing block by block data. As people get more comfortable with understanding metrics, they might understand how subjective something like transaction value can be. And with so many different people saying different things about how the market is doing and the market activity, we really need to hone down into the people that are telling the truth or are experts in the space. Lastly, stablecoins continue to show an influential role in the digital asset ecosystem. However, although they are welcome, 100%, we need to see their activity pick up, and this will definitely have a knock-on effect for Bitcoin and vice versa. So overall, an investor should consider that the fundamentals within the space are slowing or even decreasing at quite alarming rates. These need to perk up in order for an investor to feel safe in this market, which would consider quite a risky market at the moment. As far as entry points, although I can't comment on exactly the entry point, I would say that long-term value seems unlikely at this point. Although obviously my very long-term 5 to 10 year view is very bullish on Bitcoin, I would say that buying at these prices might come with a bit of pain in the months to come. And with that said, that's all for today. Thank you very much for tuning in. My name is Tom Salter. You can find me at Twitter at TomSalter1999. Thank you very much. Bye.